Good afternoon, and we are back with discussing yet another set of accounting standards today. One is IAS 19 employee benefits, and the other one is IFRS 2. Now, if you take a quick look at the exam kit, you will realize that employee benefits is tested very frequently for 5 to 6 marks. Sometimes it can come as an adjustment in consolidation, one of the questions that we did on the last weekend, if I'm not mistaken, that question had it had a full-fledged 6 marks part on employee benefit, and then those adjustments impacted our consolidated balance sheet. And you could have independent questions in section B also. And there are questions in ethics part also on employee benefits. Not a very tough standard. See, the scope of IAS 19 is huge. But what we have in our SBR syllabus is a very limited exposure to IAS 19. Okay, so let's keep it around that. Now, employee benefits could primarily refer to four types of benefits. Post-employment benefits relates to retirement. Short-term employee benefits includes wages, salaries, bonuses, and other benefits. Now, post-employment benefits are usually the ones after a person finishes, he reaches the age of superannuation. You reach the age of 60 and then you retire, and then maybe some pension benefits are to be given to you. That is covered in post-employment. What is termination benefit? Termination benefit is when a person is removed from service before he reaches the age of superannuation. Sometimes, employees are given a voluntary retirement scheme, or they are made redundant. So, they are let go, they are asked to go from the organization. That is termination benefit. Short-term benefits are, your usual salaries and wages and bonuses and all of that. And then, of course, there are other long-term employee benefits. Short-term benefits, not much of a complexity here. It's your usual salary payable to cash. Now, an item like, you know, there are sometimes employment contracts where they mention things like leave encashment. Now, leave encashment differs from entity to entity. There are certain companies which will say that so many leaves, if they are accumulated, you will be given one particular amount at the time of your exit from the company. So that is covered under. So leave encashment in that case would become a long term benefit. Some companies might say that whatever is the accumulated balance at the end of the year, we'll multiply that with a certain number and you will get that amount. So that is leave encashment in the current year as we know it, and that could then become a short term benefit. So leave encashment, it depends upon where exactly, what are the terms related to that. Now, short term benefits, as I told you, it's one of the easier entries: salary payable to bank. Yeah, for if you have given an advance to an employee and then you are going to adjust that advance against his monthly salary, so be it then. Okay, now along with that, we also have, like an advance entry. If it is going to be adjusted in the next 12 months, it becomes, you show it under current assets and then you square it off. And if it is going to be adjusted over a longer duration, then you will have to split it into current and non-current component. The one part that is going to be tested in your SBR exam is not the short-term benefit, because those are, like 11 standard entries. What they are going to test you is basically on post-employment benefits. Now, post-employment benefits are of two types. Let's understand the idea. Now, what happens is, suppose I'm working with a company. The government knows that if left to my own devices, okay, if left to my sweet will, I will probably never get in a position where I actually save some money for my future use. Okay, so I will squander all the money, I will waste all the money, and when I retire, I will again cry that the government has not done anything for me. So, to prevent that from happening, what the government says is, you know what, we don't trust you. So, every month, if your salary is 1 lakh rupees, every month a certain percentage of that salary is going to be deposited with the government. You deposit that amount, will be deducted from your salary. Your employer will also contribute a similar amount. That money will keep on getting accumulated each year, and then at the end, when you retire, that entire lump sum will be given to you. That is your provident fund. Okay, that is basically to take care of your retirement. Now, this is basically what post employment benefit is all about. Now, there could be two types of post employment benefit. The first one is a defined contribution plan, the other one is a defined benefit plan. Now, how do I remember which is which? See, a defined contribution plan is one where the monthly contribution is fixed. Okay. Defined contribution plan is something where the monthly contribution is fixed. The final benefit payable to you is not fixed. And when I say monthly contribution is fixed, it doesn't mean that it has to be a fixed amount. Every month it will be 5,000, not necessarily that way. When I say fixed, it could also mean that it is a number which is calculated as a fixed percentage of the salary. So if your salary grows, then the fixed percentage will also grow. If it is say 10% of salary, your salary grows from 3,50,000 to 5 lakh. So it will be 10% of that. Fixed contribution doesn't mean that necessarily that the amount is fixed. Fixed contribution also means that it could be a number which is calculated as a fixed percentage of something else. That is a defined contribution plan. Now, see what the provident fund authorities or the pension fund does is they accumulate the money and then they invest that money in income generating assets. Like you invest in a mutual fund, they do something similar. They invest your money in income generating assets. After that, what is it that they do? So they keep on accumulating that money every year. Okay. And then when you reach the fag end of your work life at the age of, say, 60, for example, then all that money that has been accumulated, what they do with that is they give it to you, they give that money back to you. Okay, that is the idea of a defined contribution plan. Now, because they invest in different types of assets, the returns may vary from year to year, right? The returns may vary from year to year, and final benefit is not known. But you know exactly how much contribution is happening every month. A defined benefit plan, on the other hand, is something where the final benefit is promised to you and the amount of contribution will change every year depending on the economic conditions, depending on the circumstances. Now think about it. Say I have promised Roshan that when you become 30, for example, you will be given a cash gift of 3 lakh rupees. Now, for that, what I'm doing is I'm contributing a certain amount to a special fund every year. Now, suddenly what happens is the economy is going through a downturn, so the returns on these assets are not as much. Now, my fear is, yeah, I have promised a certain amount to Roshan and the investments are not generating the return. In that case, I will increase my contribution in a particular month so that I can match up to the promised amount. So, in a defined benefit plan, benefit promised is fixed. The contribution will change from year to year or month to month depending on the return on assets, economic conditions. Sometimes there could be certain changes in estimates. For example, uh, the government increases the age of retirement from 60 to 62. That means now you have more time to accumulate the money. In that case, the contribution might go down. So defined contribution plan, contribution is fixed, final benefit promised is not fixed. Defined benefit plan, final benefit promised is fixed, but monthly contribution or yearly contribution will vary depending upon the facts of that particular time. Okay. So under a defined contribution plan, this is the clear distinction. Okay. Now I just want you to have a look at these two illustrations that I have written. ठीक है, just पढ़ो इसको एक बार.
Can you scroll down, please?
Sure. This is the benefit वाला part. ठीक है.
आंसर।
ठीक है। वरदान, हैव यू रेड इट?
यस सर।
ओके, चलो। Now, that is defined benefit plan. Final benefit promised is fixed. Contribution will change to achieve that target. Defined contribution plan. Monthly contribution or annual contribution is fixed. Final benefit will vary depending on the return generated. Now, if you're talking about accounting for a defined contribution plan, the accounting is very straightforward. What exactly are we doing here? So every month there will be every month or every year there will be a contribution payable. So our accounting entry for this will be employee benefit expense account debit to contribution payable, and then contribution payable to bank. This amount will be calculated as a fixed percentage of either salary, or it could just be a fixed amount that you are considering. Okay, and the accounting entry is very simple, and for this reason, for obvious reasons, they don't ask this to you in the paper. Why? Because it's too easy. There's hardly anything, that can be complex in this part. Okay, so that's again something which is there in the syllabus, but यार ये आने का चांस बहुत कम है. Now, let's look at a defined benefit plan. Now, when it comes to a defined benefit plan, as we said, the final benefit is known in advance. The monthly contribution has to or will end up changing to achieve or honor that particular number. So there are three aspects to a defined benefit pension plan. There is one P&L related aspect, there is OCI related aspect, and then there is balance sheet. Now let's understand what exactly happens in a defined benefit plan before we see P&L, balance sheet, and OCI. Let's understand what is the cycle or life cycle of a pension fund. Okay, try to visualize this. Pension fund collects money from employees. Say it collects 5,000 from 10 employees, each from 10 employees. The money is collected, and the fund has promised a certain benefit to the employee. So क्या होगा? Every month what the fund will do is it will collect 5,000 from each employee. 50,000 will be there. Think of a bag. That bag has 50,000. Now this 50,000 is in the custody of the pension fund, but it is not the pension fund's money. It is money belonging to the employees. We collected 50,000 from all of you together because it is payable to you. I call it a plan obligation. Obligation is payable. 50,000 is collected from you. Now I have promised you a certain benefit after 10 years. Now that money lying in my bank account is not going to fetch any returns, right? So what I will do is I will take that very money that I have collected from you, and I will start investing that in different assets. Now these assets could be gold, bonds, shares, I mean, real estate, different types of income generating assets. Okay. This money gets invested there. When this money gets invested there, what do I do after that? After that, I let it earn interest or returns or whatever for a certain period of time. Now, I have invested my money in income generating assets. Okay. Now, do you agree that these are all financial assets whose fair value will change day to day, year to year? So say suppose I have invested an amount of 50,000 in different income generating assets. At the end of the year, the fair value is 52,000. What happens to the 2,000? Naturally, I will record an entry. Investment in assets account debit to P&L. Fair value change gets recorded through P&L account. The fair value of liability might also change. It might happen that some employee leaves, so he's not no more eligible. A new employee joins with a higher salary. So, different changes will occur to the obligation also. Now, the point is, see, the obligation and the asset are in a way contra accounts of each other. The obligation is the amount payable to the customer, the amount payable to the employees. The assets are basically made out from this obligation only. The asset exists to fulfill the obligation, and the obligation is funded by the asset. These are two sides of the same coin. So instead of showing an obligation on the liability side and an investment on the asset side, in IAS 19, what we do is we net it off and we show a single figure in the balance sheet called either the net obligation or the net assets. Why? Because they are both related to the same item. They are two sides of the same coin. So we don't show an asset separately and a pension fund ka liability separately. We show it as a netted off amount. Now, see, If you remember, अपना IAS 37 हो गया, IFRS 16 हो गया. Whenever we record a liability, we naturally have to record some interest also, finance charges also. Suppose my liability at the start of the year is 50,000. I haven't paid anything naturally, so interest will accrue on that, finance charges. So that is an expense side wala interest. On the assets front, again, when I invest this money in different income generating assets, I will generate some return. That will be interest, but on the credit side. So now if asset and liability are netted off, then the interest income, interest expense is also netted off and shown as a net amount. ठीक है. So with that in mind, how we actually show that in our consolidated balance, sorry, not sorry, in the balance sheet is, there is a plan obligation, then there are plan assets. So we show only the net amount, present value of plan obligation versus fair value of plan assets. We show either the net obligation or the net assets in the balance sheet. ठीक है. This plan obligation is because you know the exact amount that you will have to pay to your, you have promised to pay your employees at a certain date. At what value do you record it today? You record it today at its present value. So if you have promised to pay, say, 5 lakh rupees to a person, you record it at its present value, whereas you take the fair value of all the assets involved. ठीक है. You take the fair value of plan assets and you have your answer. ठीक है. उसको आप नेट ऑफ करेंगे एंड देन यू विल शो द नेट अमाउंट इन द सिंगल एंटिटी का बैलेंस शीट. ठीक है. एक बार read this PV of plan obligation and fair value of plan assets wala part. Read it carefully. The thing that we have discussed, I have just touched upon that again. Done. So done. Now, what happens at the start of the first year? See, at the start of the first year, you have an obligation of 3,10,500 and you have an asset of 3,10,500. So there is no adjustment, so to say. You have a net obligation of zero. But see what happens to the obligation and the asset as 1 year passes. While you recorded PV of obligation at 3,10,500, company's cost of capital was 10%. So you had to record finance charges of 31050. The value of the obligation at the end of the year became 341,550. ठीक है. We invested 3,10,500 in plan assets. It earned a return of how much? It earned a return of 10%. It was expected to yield that much return, but maybe the market conditions were different, so you earned a return of 25,000. So what is the value of plan assets fair value? 3,10,500 plus 25,000, 335500. Now your obligation at the end of the year is 341,550 and the asset value is 335,500. So what is the net obligation at the end of year 1? It is 6050. ठीक है. And naturally you don't you show the net amount in the balance sheet, and because the obligation and the asset are being netted off, the interest part on those is also netted off, and you show only the net amount in the net amount of interest in the P&L account. You don't show interest expense and interest income. ठीक है. Now, when it comes to presentation, see, you have two options. I mean, in an ideal world, but IAS 19 specifically tells you that net it off and show the net interest income or net interest charge. If obligation is greater than plan asset, it is net interest expense. If obligation is less than plan assets, then it is net interest income. Okay. Then there is something known as service cost. Now understand, service cost is not salary paid to employees. What is service cost? Service cost means because Roshan was employed with me, I was paying him a salary of 50,000. The pension fund, provident fund rules made it mandatory for me to deposit 1500 rupees in his name in the pension fund. So this additional kharcha that I have to incur, this additional expense that I have to incur to satisfy the pension obligation is my service cost. The reason it is called service cost is it arises because of his service. It is not something which is uh, because of any other reason apart from the fact that you are employed with me. I have to make a contribution to the pension fund because you are in my employment. The salary that I pay you is not service cost. The amount that I have to deposit in the pension fund because you are employed with me is my service cost. Okay. Now, how does this appear in the balance sheet and in P&L? Okay. You start off with opening net value of obligation. How do you get that? PV of obligation minus fair value of plan assets. To that, you add interest on net obligation calculated as a percentage of the opening balance. So remember one thing. If it is an obligation, show it with a positive sign. If it is net assets, let it appear with a negative sign. Okay. Now, if it is, say, for example, minus 900, then interest on this will be this into 10%. Because this is net asset, this 90 ka minus 90 is your finance income. Credit that to P&L. ठीक है. Opening net value of obligation, add interest on net obligation, add current and past service cost, less contribution to the plan, add less impact of curtailment, closing net book value of obligation. ठीक है. This is book value of obligation. Now I have to compare this with the fair value of the obligation. So what they will do is on the reporting date, they will again give you the present value of obligation and they will also tell you the fair value of plan assets. Now that amount could be slightly different. See, this is based on the actuarial calculation. Who is an actuary? An actuary is an expert who has his expertise in valuation of pension benefits, insurance contributions, premium, leave encashment, complex mathematical models apply करके he tells you what the fair value should be. So according to your books of accounts, the value should be 800. According to this actually, the value should be 850. That means the value of the obligation has to increase by 50. That difference is known as the remeasurement component. It goes to other comprehensive income. Why? Because realistically speaking, this is not what do you call it? This is not a realized gain, nor is it an actual loss. This is just change in fair value that you are accounting for. Hence, don't record it through P&L, record it through other comprehensive income. For your examination, if you remember this table, it will help you tackle most of the questions in your exam. Just keep in mind what comes after what and basically what goes where in the consolidated balance sheet. Sorry, why am I saying consolidated balance sheet? Balance sheet and P&L. ठीक है. I think consolidation is on my mind also in a big
So,
way.
I have a small doubt. I understand what is service cost is. What is past service cost? Like,
Yes.
what's the difference between current and past?
We'll get to that. Now, you are working with me in 2024. So, based on your service in the current year, I am contributing an amount to a pension fund. Now, in the year 2026, for example, the company decides that, we want to be very kind and benevolent to our employees. So, what we are going to do is we'll make one change in the pension scheme that additional 2% benefit will be given to all those employees who have been working with us for more than 3 years, for example. Okay. And that has to be calculated retrospectively. So I calculated back from 2022 till date. So that additional contribution to the fund is happening because you served with me in the past. That is why it is your past service cost.
Okay, sir, got it.
ठीक है. There's a question not in the exam kit, but ये sheet में there is a question basically on the past service cost element. Now, what are plan assets? Plan assets are basically any assets in which a pension fund invests its money so as to meet the obligations of employees. Now, the rules surrounding pension funds are very strict. Huh? Please understand. Why do I say that? It's because, see, that is not your money. That is somebody else's money that you have kept with you. Ultimately, it is payable to the other person, which means the investment that you make in any asset here, that money. that is generated by this investment can only be used for satisfaction of the pension obligation, nothing else. It cannot be used for tax payment, it cannot be used for literally anything else. So, any bond, any mutual fund, anything that you are investing in, you are investing the pension money in, that is your plan asset. Sometimes what companies do is they also take an insurance policy. These days, you would take an insurance for literally anything. The reason why pension funds take this kind of an insurance is, what if the assets that you have invested in, when the time comes to honor the obligation and pay the money to your employees, what if at that point in time the markets are down and you don't seem to be in a position where you will have enough money to pay to your employees. So in this case, what happens is they take an insurance policy cover. How does it help them? In case you don't get enough money by that particular date, this money will be used to make payments. That is a qualifying insurance policy. And you pay insurance premium like you would pay for, like fire insurance, health insurance, anything for that matter. Okay. That is, these are basically plan assets. Okay, have a look. Not that they are ever going to ask you definitions. That is not how ACCA operates ever. But you should know what these items mean.
Done, sir.
Okay. Now, we discussed the service cost bit, current service cost, past service cost. And if the obligation amount is greater than the asset, then there is an interest on net obligation, which is an expense. If the asset value is greater than the obligation, then of course that is interest income which gets credited to P&L account. Now there could be a situation where the employee benefit gets reduced over a period of time because some of the employees are asked to leave or they are made redundant. ठीक है. A curtailment is a reduction, significant reduction in the number of employees covered by a pension plan. This may be a consequence of employees being made redundant. Like, TCS and all of these companies right now are laying off their employees, right? So, for example, they had created a provision or they had created this plan obligation for, say, 50,000 employees, and now 10,000 employees have been fired. If 10,000 employees have been fired, then naturally the value of obligation in the future will go down. Last year तक जो था वो तो रहेगा, that will not change. But in the future, you will not have to contribute anything to a pension fund for these employees. So there will be a reduction in the amount of obligation. Such reduction in the amount of obligation is called curtailment. ठीक है? And in most cases, it will create a gain on curtailment. This gain on curtailment is adjusted against service cost. It is not credited to P&L. These are situations, what happens is, say, for example, there were 50,000 employees and you had promised them a certain amount on retirement. Now, from the next year, they won't be there, but you are not settling the amount payable to them. You are just removing them from your book, from your muster, and from your, of course, records. In that case, what happens is, last year tak ka payable obligation remains the same, but from the next year the amount of obligation goes down because now suddenly you have 12,000 employees less in your system, which is why the value of the future obligation goes down. Plan assets will remain the same, and whatever is the difference, that is gain on curtailment, it goes to your P&L account. ठीक है. So there are of course a couple of questions which involve curtailment. We will see those. Now, in questions, sometimes you will get an adjustment or additional information called benefits paid. Okay. So after, say for example, Vardhan has reached his age of retirement, the pension fund has to pay him an amount of 10 lakh. Now, what will the pension fund do? Now, if the pension fund is paying 10 lakhs to Vardhan, first of all, the pension fund will have to sell the investment, it will have to liquidate the investment in plan assets. Entry होगा बैंक account debit to plan assets account 10 lakhs. ठीक है. And now when the amount is paid, you will debit the obligation and credit bank. है ना. Obligation will be debited and bank account will be credited with what number? It will again be credited with 10 lakhs. So your obligation and your asset both go down by 10 lakh. So whenever there is a benefits paid situation, the net balance doesn't change. Although individual balance of obligation and asset will change, the net obligation does not undergo a change. You can see here why that is the case. Okay? Observe this once.
Done so.
Make sense? Chalo. Now, one concept of asset ceiling. Asset ceiling basically again stems from the prudence principle. Don't overstate your income or asset. Now, there is a possibility that, see, usually what happens is most pension plans are in deficit. That is, the amount of obligation is greater than the amount of asset. There could be rare cases where the asset value is greater than the obligation. Now, if the defined benefit plan is in surplus, that surplus should be measured at the amount calculated normally, that is, value of obligation minus the value of asset, or the total of present value of any economic benefits available in the form of refund from the plan or reduction in future contributions to the plan. Now, what are refunds from the plan or reduction in future contribution? Let's say that you had projected that the plan will earn a return, plan assets will earn a return of 11%. But you had some really good buoyant years in the economy and the plan assets generated a return of 15%. On one hand, there was a projection of 11%, but you earned a return of 15%. That means the accretion to the amount of plan assets was more. You got 4% more. Now, because you got more money in the form of return, you will end up reducing the amount of future contributions to the plan because that shortfall was covered through the returns only. The second point is amount of present value of any economic benefits available in the form of refund or amount calculated normally. Whichever of these two is the lower, the amount of net assets will be measured at that particular amount. And I think last Sunday को हमने एक consolidated balance sheet का question किया था where we had seen the concept of asset ceiling. ठीक है. We'll do questions on this. Questions हम separately करेंगे on each of these. And of course, there are detailed explanations and questions available for that here. Apart from this, we do have termination benefits. What are termination benefits? Payable as a result of termination of employment. Okay. So employee could have accepted a voluntary retirement scheme. या फिर employees have been made redundant because their skill sets are no more required by the company. So in such cases, what happens is now you have to give a severance pay to your employees. What is a severance pay? A severance pay is basically you are firing them, so you end up paying them a slightly higher lump sum as a parting gift, so to say. In that case, that amount becomes your termination benefit. What is termination benefit? Amount that you are paying to someone with the intention of terminating their employment. This will usually happen when the company is going through a reconstruction or a reorganization. ठीक है. So you should record the provision the under the way IAS 37 describes, which is, when a constructive obligation is made. And when will a constructive obligation exist? A constructive obligation will exist only when a public announcement of the plan for reorganization is done. ठीक है? यहाँ पे in this particular topic, what matters the most is asset ceiling and उसके related questions, then how this curtailment table works, and the format for defined benefit plan that I showed you. These aspects are the most important. बाकी उसमें कुछ और है नहीं. Technically, IAS 19 is a complex standard, but not in your SBR paper. ठीक है? Are you with me?
Yes, sir.
Okay.